Hello everybody and welcome to our Financial Planning for Your Business webinar. Thank you so much for joining us today. My name is Ruth Lambert and I am a Development Manager with the Federation of Small Businesses working in Somerset and Wiltshire, and I'm one of the team who's helped put this session together today. I'll shortly be handing over to John Mayer, who's our area lead for Somerset, and then we'll have presentations from our two guest speakers today, who John will introduce to you. And then after that, we'll be opening up to questions. Now, some of you very kindly forwarded some questions when you booked, so we've got those, but do feel free to add any questions that occur to you whilst you're listening into the Q&A box. So preferably not the chat box, if you wouldn't mind. The Q&A box would be really handy because then I can see them easily and we can try and address as many as we can when we get to the end of the session, and we should have about 15 minutes or so to cover those. We are recording the session today, as you will have noticed, and it'll be available on the on-demand page of our website very shortly after the event. So if you want to watch it back or share it with any friends, please do check it out there. And we hope that loads of you are FSB members, but if you're not and would like to find out more about being an FSB member, please do have a look at our website at fsb.org.uk, and you can book to have a chat with a membership advisor if you'd like to find out any more. So that's enough from me for the moment. So I'm going to hand over to our area lead for Somerset, John Mayer. Over to you, John.
Good morning to all. Yes, my name is John Mayer, area lead for Somerset and North Somerset. And I'm also owner of a Taxist Accountants franchise of Weston-super-Mare. And looking at this session today, it's all looking at your future financial planning. Very important because we're all heading up towards retirement age, some of us nearer than others. And your future is so important to you. And we're very fortunate to have two experts here today. We've got Annika Gazelle from Annika Gazelle Wealth Management. We've got Matt Hobbins from Unique Financial Planning, who are today sharing their expertise. And I will be in the background if anyone has any tax questions they need answering, which Matt or Annika can't field. So I think on those grounds, I think it's right to hand over to Annika, who's going to launch us off. So Annika, over to you. Thank you.
Thanks, John. Matt's just going to share our slides for today. So just bear with us a second, please, while we get those up for you to see. So the aim of today really is, it's financial planning for your business. It's very easy for us to get bogged down, I think, in the day-to-day running of our businesses and stop and not have the time to stop and think about what we're trying to achieve and our kind of aims and objectives. So today, Matt and I are going to run through just some of the key financial planning areas that should be kind of part of the consideration to think about for your financial plan. So throughout the session, we're going to have a few polls. So if you don't mind answering those, that would be really great. We can just kind of get a bit more of interaction through the session rather than us just kind of talking at you. And as Ruth mentioned, there's going to be time for questions at the end of the slides. So if we just move on to the next slide. These are some of the areas that are considered when we're kind of thinking about financial planning. This can be in many different formats. So everybody out there is going to have different aims, different objectives, and businesses are going to take all different shapes and sizes. So it's difficult for us today to cover every aspect to suit everybody's circumstances because each plan is going to be bespoke to you. But the aim is just to kind of try and cover a few of the key areas that really should be on your radar, and we'll go through some of those today. So, protecting you, your family and employees, that is really at the centre and the core of any financial plan. If that's not in place and at the right accurate level for your circumstances, then any other kind of future plan can fall down. Cash flow, we all know when running a business, cash flow is really important. So getting a real tight grip on your expenditure and then kind of any income to kind of just get that real good view of what's coming in and out of your business. Then we've got maximising reliefs and allowances. There are so many different reliefs and allowances out there that it's really good to get a handle on all of those available to you. And just say, for example, if you have a spouse working in your business, are you maximising the reliefs that might be applicable to them as well? So trying to kind of really look at all of those and how that might relate to you. And then maximising cash. If there's cash building up in a business, apart from anything that's earmarked or available for kind of day-to-day running of your business, could you be putting that to better use and kind of making your assets really work for you? So reviewing that as well. So I'm going to bring Matt in here now. He's going to run through a few more on the slide.
Yeah, thanks, Annika. So tax efficient capital extraction, obviously for sole traders, a bit more limited. So you've got, net profit, your drawings essentially. Limited company, you've got more capacity to sort of do more things. You can take a salary, dividends, pension contribution, and even pay for protection for both you and employees. But we'll cover a bit more of that later on. Retirement and obviously helping you post sale of the business. Really, there's something we use in our day-to-day business, which we'll show you later on, called cash flow modeling, which really sort of covers how you can use that to answer those points. Exit planning. This is really something where someone like John would really come into their own. Our advice as financial planners goes to a certain point, and then an accountant would sort of come into the mix as well, and we would work together to make sure that that's done in the right way. There's loads of different ways to exit a business without stating the obvious. Estate planning is really important. Lots of people selling a limited company might not realise, but as a limited company, if it's qualifying for business relief for inheritance tax, so you don't pay any inheritance tax on it, sell the business, you've got a load of money. If you've got a load of money sat in your estate at that point, it could then be liable. So there are specific investments out there that mean you could move it into that world and keep the business relief. So basically save your estate from paying a massive inheritance tax bill. We've got a poll coming up for you, so I'll just bring it on screen and read it out for you as well. So this is, do you at least once a year check you're making the most of the tax allowances, exemptions and tax saving opportunities available to you? Yes or no? So if you wouldn't mind answering that, we'll give you sort of 30 seconds or so to answer. Hopefully Joy can let us know when everyone's done. Okay, so you've got yes 41% and no 59%. So that's pretty close really. So okay, interesting.
And yeah, good split there.
Yeah.
So that was one of the reasons we asked that question, really to just really get into the reasons of why it's important. And making the most of your allowances is a key way to start being as tax efficient as possible. We've seen over the last 10 years that it is more expensive than ever to, in a tax perspective, to get money out of a company or your business. We've seen the lifetime allowance come down. We've seen the annual allowance come down. We've seen tax dividends kind of go up. So, that it's all become a bit more expensive. So it's really good to kind of get that holistic view and that long-term view of everything.
Okay, so this is just to sort of run through really where the tax situation is for this tax year. Most of you will probably be aware, but the most thresholds, in fact, pretty much all of them have been frozen because of COVID. The government debt obviously has been ramped up. So rather than tax us more openly, the government really have employed a bit of a stealth tax. So they've frozen allowances predominantly up until 2026. So essentially that means that people will be earning more, obviously, and as they earn more, well, hopefully, and as they earn more, they're going to creep into those bands and obviously pay more tax. So they're not increasing the rate of tax, but they are increasing taxation by that merit. IHT bands have been frozen for many years anyway, so that one being frozen isn't really too much of a killer. New for this year is obviously national insurance increases. So pretty much, most people will be aware that's happening, but there are ways to mitigate it. So if you're an employer, so a limited company, and you employ staff, you can offer salary sacrifice, so people give up part of their income to go into a pension, and that saves the employer and the employee national insurance. And as an employer, what you can do, and some people do this, is offer some or all of that as a benefit. So they put it into the additional amount that they're saving back into the pension. So that can actually be a bit of a nice value add really to your employees.
So to try and bring this to life a little bit, we're going to look at the effects. So, and we've got a real life example just to try and bring to life some of the numbers. So if we can just go on to the next slide, Matt. So this is just for example purposes. Everybody's going to be in a different tax position, and everybody's circumstances is going to be a little bit different. But ultimately, we just want to try and show how you can extract money from a business when it's a limited business. So ultimately, there tends to be about 3 ways to do that. You can put money into a pension. You can take it as dividends, or you can take it as a salary or kind of bonus. We could have a whole session on the pros of pensions, and probably can't spout enough that they are a really great way to save in a tax efficient way. Both kind of either as a contribution. You can see here that if you wanted to put £1,000 into your business, that full £1,000 goes into kind of your pension, and there's no tax implications on the accumulation phase. There is when you start drawing it down, but initially that full £1,000 would go into a pension. And they're also good to think about in terms of kind of long-term planning and estate planning, because the pension can sit outside of your estate. And when it comes to businesses, there will be some businesses that you can have an exit plan and there is a saleable value, but for many others, if you are your business, then it's that old saying of, not all your eggs in one basket. It's good to kind of have options of having kind of pensions and different assets to go to in retirement. So we'll set that aside. So the main aim of this example now is to really look at salary versus dividend, really, and what could be the best way for you to extract. So this example is based on a director that is a basic rate taxpayer. They don't have any of available dividend allowance, which is £2,000 a year. They've utilised that, but it has kept them within the basic tax band. So what happens if they were to take £1,000 out, and how would that look? So based on last tax year and this tax year, you'll see kind of in that final line here that dividends do tend to win. You're not paying then the additional national insurance contributions. And with this tax year, as Matt's already mentioned, we've seen this healthcare levy of 1.25%, and both the employer and employee will be paying that. So in essence, it's a 2.5% addition. So we've seen the gap slightly widen between taking a salary versus taking a dividend out of the business. So that tends to be kind of, circumstances will dictate, and as they change within your own different kind of areas or business. But ultimately, in terms of how much you can get, dividends still tend to be the right kind of way to take money from a business and to get that maximum amount, even with the increase in dividend tax that we're seeing this year. Next year, there is currently on the cards to have an increase in corporation tax. And looking forward, based on the amounts that the government have set out initially, then as a basic rate taxpayer, dividends still are kind of coming out above that. But it's worth kind of then saying, take stock and have a look at your numbers if you fall into either the higher rate taxpayer bracket or the additional, because then the numbers might start looking more attractive for a salary. So it's really good to kind of work with your accountant, or sit down with an advisor and just look at what might work for your circumstances and kind of the extraction of the best way for you.
So impact of frozen allowances, basically the inheritance tax has been frozen for 17 years. So if we just look at what a 5% growth would mean over this time. So this gives you an idea of 2009, you've got assets, £400,000, there's a nil rate band of 325,000. So at that point in time, 75,000, would be taxable, which would be a tax bill of 30,000. So if you grow that 400,000 up to 2026 at 5%, you can see just the figures there without reading them out. You can see it's a considerable difference in tax, and that's just because the nil rate band has been frozen. Even if you include the new residence nil rate band, which is introduced in 2017, and that allows somebody with a property essentially to pass it on to children or stepchildren or foster children, adopted children, that sort of thing. It allows you an additional £175,000 each, but still it's quite a big hike in tax. So that's what we were saying earlier on about the bands being frozen. It's essentially still taxation. In fact, from April 2021 to February 22, IHT receipts were 5.5 billion, which is at 0.7 billion higher than the same period a year before. So to give you some idea of the increase in tax to the Treasury. So another poll coming up for you. So do you regularly save into, and you can actually select multiple ones here. So you can select, single choice. So ISAs, pensions, other investments, or don't save. If you can click those, please, and see how that comes. Okay, so we've got 31% ISAs, 28% pensions, 11% others, and 30% don't save. So that's, would you say it's fairly indicative, Annika, of what you experience?
I think it varies. I think, apology, we probably should have had multiple option there. Didn't realise that we had that set up, because I'm sure many of you will might maybe do a few of those. But yeah, I think it's the reason there is Matt's going to kind of talk about the key eighth wonder.
Yeah,
leads into it.
Yeah, exactly. Nice intro. So yeah, Albert Einstein apparently, I think he's quoted somewhere as saying that the compound,
isn't it?
yeah, compound interest is the eighth wonder of the world. Or he actually said, he who understands it earns it, he who doesn't pays it. But just to sort of give you an example, this is something it's known in our industry as the cost of delay. So not doing something has a value to that. So we've got example here of Daisy. She's paying in £200 a month for 40 years. I think it says Sophia on the slide there. And we've got someone else as well. As you can see later on, the other person's Ben is paying in £400 a month for 20 years. So they're both paying in £96,000, but with 5% compound interest. At age 65, the early starter, so Sophia, has actually got £306,000 in value in her pot, and Ken's got 165,000. So it's just the power of compounded growth. So money makes money basically is the key to it. So starting early and not necessarily any considerable amount. The any amount you put in is definitely worthwhile. So I think it's just your slide out, isn't it, Annika, to intro this one?
Yeah, so we're shifting gears a little bit. We're moving away from kind of the cash flow and looking at money and now talking about kind of protection. So this poll question is, are you confident you have the right level of protection for you and your business? If you could answer yes, no, or you don't know, that would be great, please. As we kind of move into a slightly different area to focus on now. Hopefully those answers are coming in now. Okay, so yes is 26%, no 25%, and don't know 49%. So brilliant. So the reason we kind of asked that question is just to kind of get some insight and align really. There's a report produced by Legal & General called State of the Nation. They go out and interview over 500 small and medium sized businesses to get a feel, basically asking them questions about the potential risks they may face, their awareness of risks, and how they as a business could mitigate them. So the report really throws light on the risks facing some UK businesses and highlights the need for kind of expert kind of protection advice. Because I mentioned at the start, having the right level of protection, whether you're a sole trader, and that could be elements of critical illness, life assurance, things like that, or you go across to some other elements which Matt will kind of cover in a second of business protection. There's so many different elements out there, and it's really important that even if you do have them, you're reviewing them regularly to make sure that they still fit your circumstances. Because many people, they will default maybe to an accountant, and this report showed that 70% of the businesses that they interviewed had an accountant, but only 40% actually referenced to a financial advisor about kind of getting guidance on things like business protection and advice and what that might do. And you can see here that the top 3 risks for a business, 52% came back and said, the death of an owner or a key employee. Those are those key drivers that are really driving those small and medium businesses. If they were to lose a major contract loss, that would really severely impact 38%. And then if an owner or key employee suffered a critical illness, that would really kind of cause a bit of an impact as well to another small business. So there's just those kind of, it's trying to bring kind of another light of what other business owners out there are doing and thinking.
So with business protection in mind, the key message really is it's for everybody. So really sole traders can protect employees. If you're a sole trader and you're actually employing people, obviously you can have protection for them, but you also really need to look at your own personal protection. As Annika said earlier on, That's the cornerstone, the keystone to financial planning, is making sure you're actually fully protected. So you can see on there, there's lots of different ways to actually consider or look at for business protection. So key person is to protect literally a key person within the business. So it could be the main salesperson, it could be the financial director, it could be the logistics person, it could be all of them. Business loan protection, obviously, to make sure the business can carry on paying the loan if something happens. And shareholder protection means that if there's multiple owners of the business, they've each got their beneficiaries have got the money essentially for the swapping of the shares. So they don't probably want to run the business or be involved in it. So the business can carry on, but the beneficiaries actually get the money. A real live example of where we come in as planners, I went into a business to talk to them about what they thought would be the accountant recommended pension contributions. I sat down with them, and they're a 60-40 owner limited company share split. And their turnover is going from 100,000 to $1 million this year, and there was no shareholder agreement in place. So they thought it would be pension planning. It was nearly a 4-hour meeting, kind of unpacking everything. So the key really is holistic planning and making sure that everything is in place for you.
So I'm aware we've really rattled through so many different areas, and there is a lot to cover. And as Matt mentioned there, holistic planning is the aim. So we just tried to pull out here a couple of examples just to bring to light a couple of kind of key conversations that you'd have, or things to think about if you fall into kind of more of this area. So this case is Sam Lomez. He is 54 and he's a partner of a limited company, and there's 3 equal share partners. Divorced with 2 children, and is planning on stepping away from the business at age 60. So some of the kind of conversations and things that he should be thinking about is, within the business at the minute, as kind of, is there business protection? As he's approaching kind of retirement and wanting to step back, how does his retirement plan look? Does he have the right amount of income that's going to support his future? It could be kind of a 30-40 year retirement. How does that look for him? Is it the lifestyle that he really chooses and wants to have? So we'd look at things like, is there salary sacrifice within the company, or has he got options to use carry forward, which is utilizing your annual allowance and carrying them forward from the past couple of years? Then, as looking at exit planning, what is written in the partnership and the shareholder agreements of how somebody can leave the business? That's really crucial. And then estate planning, so ensuring that wills are up to date, any lasting powers of attorney. We've put here that he's divorced. Wills, has it been kind of reflected since he's been divorced? Because a divorce doesn't actually kind of stop any future kind of or past, wife kind of getting hold of it if it hasn't ended well. So a marriage does kind of nullify a will, but making sure that basically all your assets and all your kind of documents are up to date and in line with your wills, wishes and expectations. So really important, lots of different areas to think about for this kind of case study.
Thank you, Nick. And then we've got a sole trader, Nina, and she's an IT consultant earning 48,000 a year. Previously been employed. She's got a couple of children, got some cash savings. Partner's earning £55,000 a year employed. So for them, there's quite a few things: protection, life insurance, that kind of thing to review. And then we've got historic pensions, whether or not there's something worth doing when moving. Personal pension contributions are definitely a really good idea. It's been both counts because they're going to get tax relief, and then moving some of the cash into stocks and shares and an environment where they're actually going to get some growth as opposed to be eroded by inflation. So what we're going to do now, with sort of like nearly 10 minutes left, is you show you something we use, Annika and I both use, something called cash flow modeling. So this is a real, a live example of what we use, and to help people essentially see, are they comfortable in retirement? Can they retire when they want to? And it covers a multitude of needs as well. So I'm just going to go to here. Okay, log in. So this gives you, this is the, you saw on the previous slide, the configuration of where they are. So this gives you what we would call a master plan, or if you like, the start point really of their lives. So
Matt,
yeah.
We can just see the slides. You need to stop sharing the slides and reshare.
Sorry. Ooh,
PowerPoint's still on at the minute.
stop sharing, yeah? Okay.
Yeah.
There we go. Back to there.
And then share again with your model.
Sorry. Can you see that?
Yeah, brilliant.
Great. Sorry. Okay, so this is their sort of life as it stands right now. So this is our sort of your start point without Annika and I in their lives, really. So we've just basically plugged in everything that we know. Without going through everything with you, it just gives you a run through of a few things. You can see on the screen it says surplus income nearly 30,000. So as they stand, they've got surplus income over their needs, which is brilliant because most people tend to be hopefully earning more than they're spending. The black line, you can see it says total need. That it covers mortgage, tax, it covers everything that they need to run the household. And they want £30,000 a year to sort of have as a lifestyle expense as well. So as we sort of scroll along, you can see it increasing with inflation. So don't worry too much about the numbers. The main thing really is the fact that there's the increase there. And over here, you can see the red, the shortfall. So there's a need there. So in this example, if they retire when they want to, they run out of money at 80 and 77 respectively, because they're 3 years apart. Like most have a slight difference in age. So quite commonly what we see is people say, oh, I think my life's fine, I'm going to retire at this point in time, this is where I stand, and actually that isn't actually quite realistic. So what we can actually do is say, well, look, if you actually contribute money into pensions, so if you basically increase your contributions, say for both of them, for Nina and for Martin, increasing it by £5,000 a year each, it does two things. For Nina, it gives obviously a valuable pension, but for Martin, he's at 55,000, so contributing £5,000 gross to a pension means all of his income's at basic rate at 20%, not 40. And it also means that with children, they're getting child benefit, and he would be getting a tax charge on that difference over the 50. So it recovers all of that for him as well. So it's basically a double whammy. And you can see there the delay, really, it pushes it right the way back. So that red line now is still coming in, but it's coming in much later on. Another thing to consider is to say, well, what about if we move their cash into stocks and shares ISAs? So just show you the impact of that. Commonly, people think cash is safe. It's great because there's no market risk there, or it's not open to being lost. But obviously, inflation at the moment is pretty high. So your money basically is just not growing at all. And I'll just compare for you and show you how it looks in the two sort of realms. So you've got, let's go to later on, and okay, so you've got the ISAs here. So they've got £30,000 initially, Martin and Nina, and the children have actually got 9.5, 12.5, slight difference, but they're paying them £2,500 a year. And the main thing really is to show you, this is the if you look at the figures here for them, the cash ISAs there versus converting it. Obviously they're getting more money with growth. So investing the money rather than leaving it in cash means you're looking at quite a big difference in money there. So the power of the cash flow modeler really is there's loads of things we can do with it. The main thing really is if the client actually said, well, what about if we do all of it, contribute to the pension and actually pay in, how would that actually look? And the difference is there for you. So the bottom one is the starting out without us in their lives. And then Annika and myself would work with the client and say, well, look, actually, you need to contribute to pension and benefit from the growth of your cash by investing it. And you can see there the impact is remarkable. It means they are able to afford a more comfortable retirement. They can retire basically at the time they want to and achieve their goals. What we would look at with them obviously is protection, inheritance taxes, loads of things this can do for us. The other thing that we often see, I'm sure Annika will agree, is that people tend to try and align retirement. So, if you're sort of a few years apart, sometimes a client will say, well, how would it look if we both retire at a similar point in time? And we can do that as well. So we can align them. And in this example, it would probably look okay. So by working with us, we're able to add quite a lot of value to them and actually be able to sort of demonstrate that. This is pretty robust as well. So we can actually look at their conservative growth rates and things. We can look at the assets as well. So you can do masses of things. But essentially, you can see here, this is the top one there. You've got the pension line being spent there. And in the bottom line, the pensions run out and all you've got left is the home to pass on to the kids. So hopefully that wasn't too much of a whistle stop. Annika, do you want me to sort of have a look at anything else? Is there anything you want to?
No, I think it's, why I really like Voyant is just it brings planning to life a little bit. I mean, it can be quite dry, admittedly, talking about finances and just thinking it can be boggling sometimes to think, oh, what does that mean? What does that mean to me? So Voyant and cash flow modeling can just bring your plan a little bit to life and relate to you a little bit more. I think in essence, that's what's really key. And you can kind of just go, you know, you can have as many scenarios as you want. You kind of go, well, what if I did this? Or what if I retire in 5 years' time? How would that look? And you know, it can bring an element of peace of mind and confidence in what plan that you have. You know, that's never set in stone, and you can kind of just mold it to see all those different scenarios and what might suit you and what might suit your circumstances, because ultimately it's about the lifestyle that you want now and the lifestyle that you want in the future. So it's kind of giving you that confidence and peace of mind to kind of show, you know, is it attainable, and can you kind of reach that? I mean, it's not set in stone, and Voyant can give you some insight, but it definitely kind of gives you some confidence to see what it might look like for you. So I think that's the beauty of it.
Yeah, and it does loads of things, doesn't it? Where you can actually look and see what the how much life insurance you need for each other, can't you? You can run sort of different examples and show if somebody dies what the life cover need is. Quite often people think they've got enough protection, and it does loads of different things. You can actually calculate and say this is the value that you actually need to protect. So often as a planner, you know, we're not sort of pulling it out of a hat. We're actually using these kind of tools in the background to value how much you need. A lot of people don't really realise, you know, if they're earning sort of 50,000 a year and they're working over 20 years, it's £1 million that you're actually worth. So valuing that need is pretty important. So I think we're pretty much on time now. Shall I stop sharing?
That's great. Thank you, Matt. We just unpin you as a speaker so we get all of us in. I'm not here we go. Oh, hang on, here we go. I think we've got all of us now. Right, John, if you'd like to switch your video back on as well. Thank you so much, Annika and Matt. That was really interesting and a big yeah, I haven't started my video. That's not a good start. Apologies for that. Just thank you so much. That was a lot of things that you covered in quite a short space of time. So it's but really interesting, and I think it's going to be the sort of thing we're going to want to watch again and again to just check that we've got all the points. I'm just going to share a quick slide now that has the contact details from Matt and Annika on it. So if you're watching now and just want to save yourself writing down, I'd suggest you taking a photo of the slide so that you've got that, but it will obviously be available on demand.
And I think, Ruth, just to, you know, often there's a bit of some barriers sometimes with talking to financial advisors. So Matt and I both hope that, you know, we're approachable. It can just be a chat. There's no obligation, there's no upfront fees. People can just use us as a sounding board to kind of just get a sense of, am I in the right place? Do I need help, or actually I'm good? But it's just trying to break down the barriers to what it means to talking to a financial advisor. And I think that's what we're trying to put across a little bit.
Yeah, no, thank you very much. And I think you've both seemed very approachable today. I'm going to run through some of the, so someone's asked me to bring up the contact slide again. I can just quickly. Here we go, so that you've got it. And in the chat, we've put the link to the on-demand website that I mentioned at the beginning. So once the recording is available, it'll be there. So if you want to click and download that from the chat and save it as a favorite, then you'll be able to find this webinar again and any other webinar that FSB has recorded and put up there. So I'm just going to take the slide off now and come over to some questions. So thank you so much to everybody who submitted questions in advance and also who put questions in our Q&A now. I see there's loads coming in the Q&A, and just to say that if you don't get your question answered today, do drop Annika or Matt an email, and I'm sure they'd be very happy to help, but I will do my best to rattle through as many of those as we can get to. And where you'd like to come in, John, please do let me know. So we had a couple of questions about salary versus dividends and sort of minimizing your national insurance payments and your your corporation tax liabilities and things. So could you just clarify whether, because some people are saying that they'd always thought that it's good to take the minimum salary up to the national insurance threshold and then dividends to top that up. Now, with all the changes to the rate that we're being charged now with national insurance and with corporation tax, with dividends, is that changing? What's the recommendation for what you should do in that respect? And who'd like to answer that?
I think that's kind of like bordering on a John one, really. I mean, it depends on the circumstances, doesn't it? Because if they're, without sort of broad brushing it, if they're over state pension age, then there's no point in paying the salary and getting the NI credit. But if they're below it, probably fair to say, John, isn't it? It's probably more beneficial to still take the salary and then top it.
You would take them, but the advice would be, generally speaking, that we get our personal allowance and national insurance and tax. We also get a £2,000 dividend allowance. So the first rule of thumb is always use those allowances. So the advice would be to take a salary up to those limits, and then take dividends as a limited company. Obviously, we're talking about here the dividends are up and above that. It very much depends if you've got any other income coming in from rental or from pensions, etc. Then you would automatically then not take a salary, so you'll revert back to dividends. But it's best to take advice from an accountant on that, for sure.
Yeah, and I think if the example that I used confused anybody, that particular case study was somebody that was already in the 20% tax bracket, so not kind of below, just using up to the thresholds, just somebody. But ultimately, people need to live, and you need to be able to pay your bills. So it's got to work for your circumstances, and it's just then doing it in the right way for you, and having the money that you can kind of pay your bills.
Okay, thank you very much. So another question that we had was, you mentioned business protection, and someone asked, is there business protection for a sole trader or just for people that are part of a limited company?
So I could see you starting to talk. Go on.
And so, again, it depends on circumstances, but sole trader, generally, you would want to look at your kind of personal protection as a first starting point. So things like life assurance, income protection is really key when you're a sole trader, and things like this family income benefit as well. So that is the starting point before kind of moving into business protection, where that is more for limited companies and as you kind of grow the business.
Okay, thank you. And then a question about pensions and tax relief. Someone has asked, could you just explain in a bit more detail the tax relief that you get on pension contributions, please? Matt, do you want to come on that one?
Yeah, obviously, if you're, I think is it a personal pension? I'm guessing by the question. So, yeah, I mean, if you're a sole trader or and you're paying in to a personal pension, you get tax relief. It gets grossed up, so you're basically getting 20% tax relief. I'm not sure if they're asking about pushing the basic rate up or just generally. So you get relief, what's called essentially tax relief is at your 20% automatic. And if you're over certain thresholds, so like 50,000, then you get tax relief at 40. So it's basically, it's worth paying into a pension to get the relief. You'll get immediately 20%. If you're a higher rate, you'll get more, and that can then bring back some allowances for you. Yeah, so if you think of that in numbers, if you were to put, so that £100 was to go into a pension pot, you're actually, as a 20% taxpayer, only putting £80 in. So, but you're getting 100% because you're getting the tax relief on that. And then if you're a 40% taxpayer, you're putting £60 into a pension yourself net, but it's grossing up then to 100. So that just shows how kind of beneficial they are as a tax relief option.
Thank you. And if you were just going to do one sort of saving, would you recommend pension, ISAs, savings account? What's your top one that you think people should do if they're just starting?
Well, Annika and I probably both answer this one. I think it depends on the circumstance. You need to speak to somebody and see, because you've got access. So if you're 25, 28, you can't access a pension until you're, well, now it will be 58 soon. So if you need it to do something with, or you want access, you would look at an ISA. If you're completely confident that's spare money and you're happy to do a pension, then obviously pension's got the immediate tax relief to it. So you need to sort of talk to somebody.
Okay, thank you. And I don't know why I'm spotlighted there. Sorry, I'm just going to put this all back to being on the screen, so hopefully everybody can see all of us. So another question related to pension was, someone says they've recently become a freelance designer working on a sole trader basis. She's 28. And how much would we recommend that she puts into a pension pot per month? So how does she work that out?
Do you want to go, Annika? I think we'll both say exactly the same thing. So I think you answering this one.
Yeah, it is all about lifestyle. So that's where Voyant can come in as a really nice tool. You can kind of think, right, well, what type of retirement do you want? What type of lifestyle do you want? What have you got already? Maybe if you were employed, you might already have some pension pots that you want to kind of see what those kind of values are. And see what they might give you. And if you suddenly thought, oh gosh, that's not very much for me to live off, that's not the retirement I want, it might then kind of mold the decision that you want to take. But ultimately it has to be affordable for your lifestyle. That's Voyant was the tool that we both used, VOYANT.
Thank you. Okay, so another question is, what is the difference between wealth management and financial planning?
Absolutely.
Oh, and sorry, someone's just queried, what's Voyant?
Yeah.
Could you just before you move on, just clarify what Voyant was?
Yeah, so Voyant was the tool that both Matt and I use. There are other tools out there that it's coincidence that we both use it and we both like it. It seems just to be the most user-friendly and visual, quite nice. What was the question, sorry?
Oh yeah, what is the difference between wealth management and financial planning?
Yeah, absolutely nothing. So I would probably relate to myself as a financial planner the same as Matt. I think it just happens to be I'm associated with St James's Place Wealth Management. So when I kind of started my practice, that was kind of the route to take to align to that. But ultimately, it's all about financial planning and looking at a holistic picture. It's kind of tomato type of thing.
Yeah.
Thank you.
Sorry, it's probably worth pointing out to the person asked, but Voyant isn't something commercially available to the public. It costs a fortune to have the license for it. So that's why, we as planners would use it, because we pay an inordinate amount of money to have the licenses to use it.
No, that's useful to know. Thank you. And a follow-up question is, so how do people know who they need to talk to? So do they when do they need to talk to an accountant, and when do they need to talk to someone like yourselves? So what's the sort of general ballpark differentiation, or should you start with one and move on to the other?
I think generally it starts with one, and then the other gets brought into the equation. So commonly, I think we're all in agreement that self-employed people tend to have an accountant, don't they? I think Annika's got a stat on it. It's been like 60%, wasn't it, Annika, with an accountant? 40?
Yeah, 70. Just that small poll was 70. I think when you start a business, as it grows, you just want that support from an accountant to make sure that you're doing everything correctly. And paying the right taxes. You don't want HMRC come knocking on your door. So an accountant is a great starting point.
Thank you.
Generally want to bring the other in and work with them.
Yeah, and then it's when you step back thinking about kind of your wider financial plan and the security in your lifestyle, that's when you start thinking about talking with financial planning.
Thank you. And Matt, you were querying about whether the previous question was a personal pension. We've had a related question, which is, if you're a director of a limited company, is it better to start a private pension or to have a pension through the limited company?
Well, you would make an employee contribution as an employee of your company. Yeah. So it would be, the guise of the whether it's called a personal pension is not is irrelevant. It's where the money comes from. So you would pay it from the limited company as an employer contribution generally, because it would be better for tax.
If I can step in, actually, I think Matt just add a bit in there. I think the decision would be if you're going to decide to put money into a pension outside of your company, or whether to put money in. If you put money into a pension outside of your company, and Matt and pull me up if I'm wrong with this, but you're limited to your salary, to what you can put in. Whereas if you put money into your limited company, you're limited to the £40,000 threshold. So, but I'm sure you can add to that, mate.
Yeah. Basically, it's got generally for a lot of people, it tends to be more beneficial for that reason, because they're obviously paying themselves a salary of like 10,000 a year, because dividends aren't classed as earnings in that respect. So you're, as a limited company director, generally most of them, as John said, will be paying in from the company because they've got a higher allowance, basically 40,000.
That's great, thank you very much. We've had someone in the audience ask, they're from a community interest company, and they were saying, is there anything different that they need to think about being a CIC, community interest company, or are the rules basically the same no matter what your business structure is? Maybe John, that's one for you.
Yes, more than happy to do that. A community interest company is set up, it's more almost on a charitable basis. So the view would be that you're running it on an altruistic basis and not for profit. And thus, because it's not for profit, you wouldn't be taking dividend income, so you'd only be taking a salary from it. And normally CIC companies set up, they have greater access to grants for that. So there's a reason. I also mentioned here, I've related that, it's limited by guarantee companies, can be limited by guarantee not for profit or for profit for shares. So but again, you should be taking advice from an accountant as to why you would go down the route. But in essence, a CIC, you'd only take a salary, you would not have, you could put money into a pension pot, but there would be no, it's not for profit anyway, so there'd be no reduction in corporation tax, so no benefit there. But certainly still worth considering.
Thank you. And another pension related question was, do you need to be making a profit in your business to be allowed to contribute into a pension?
Shall I answer that one?
If you like.
You don't. I mean, effectively, if you put money into a pension and you're not making a profit, you're just increase your loss. The question is whether it's wise or not, and whether revenue and customer over a period of time take a dim view of that, especially the company that's never go down. They would see you as a preferred creditor, and they can well come down quite hard on you. Yeah, related, yes, you could, but would you?
Yeah.
No, that's a good point. So always talk to your accountant about these sorts of things. And actually, you mentioned Her Majesty's Revenue and Customs, and somebody asked, if you make a mistake in your tax calculations, what sort of trouble can you get into? You know, is it acceptable to make a mistake, or are there awful penalties if you did something inadvertently? So what's the situation with that?
Yes,
What's that, John?
That's got to be one for me, really. I mean, let's put it in context. You can't be put in prison for a start. It's not a common law crime. It's a tax. So if you break any rules, you're breaking tax rules, and that can be penalised by interest, penalty and interest, or surcharges, or actual tax penalties. But you cannot be put in prison. It's not a common law crime.
Okay, thank you. Well, that's good to know. So one for all of you then, really. So if somebody doesn't have an accountant or a financial planner, what are the trusted ways to go about finding one that's going to know what they're talking about? So if we start with accountants first, John, how do you find a good accountant if you haven't got one already, other than you, of course?
It's got to be ask others, really. Referrals are one of the most common ways of really getting a trusted advisor. But you can look at reviews. You can take a view whether the reviews are trustworthy or not. But you look at the Google reviews or Trustpilot reviews. And so you can go to the websites and generally get a view of what accountancy practice is like and how it comes across. I think that's the three most common ways, really.
Okay, thank you. And Matt and Annika, what about finding a good financial advisor?
Yeah, much the same. Reviews and referrals are always good, but I think talking about money is a really personal and quite an emotional topic. So you have to have a really good relationship and be able to trust who you're working with. I think ultimately that's what it comes down to. You have to feel comfortable, because you know, the aim is to have a long-term relationship. So, you know, you'll be meeting this person quite a few times, and then regularly throughout a long 10-20 year period plus. So you have to kind of really, really trust them and know that they'll know all sorts about your lives, and you need to be able to have open conversations with them, and you'll know if you click with a person. You know, that's ultimately what it comes down to.
Yeah, no, that's good. So maybe try and meet with a few people and just see who you get a good vibe from. Yeah.
Yeah.
No, That's good. Thank you very much. Okay, so I've got a bit more of a technical question for you here about pensions. It says, I've heard about carried forward pension contributions. Can this be used via my, I think he means limited company. So what are carried forward pension contributions? I haven't heard of those.
Yeah, that's actually, you've got an allowance, a £40,000 annual allowance, where you can actually, and that can, if you're not using it, it can basically roll on each year. So you've got the current tax year 40, and then you can go back 3 tax years. So you've got a basically £160,000 allowance. And in a nutshell, yes, you can. Obviously, as John said, it's down to profit and a number of other factors and whether or not you need the money. But if you sat on I had a case recently where a guy was sat on £200,000 excess cash. That's got more problems as well, because it means the business might not qualify for business relief, so that it could make his business inheritance tax inefficient. So recommended a pension contribution because he had one set up of 160. So yeah, you can.
And just in case anyone hasn't heard of it, what do you mean by business relief?
Okay, yeah, that's a relief you get for essentially having it was started in 1976, so it's essentially one that was set up to allow businesses to be passed on to families, really, or to sort of other people. So it means you don't get taxed for inheritance tax. There's qualifying things involved with it. It can't be an investment company and a number of other things, but basically you can pass on a family business. If you make magnets and the business is worth £5 million, you can die and it can be passed on without any inheritance tax potentially being paid.
Okay, thank you very much. So one other question we've had is from someone who's right at the beginning of their business journey. So they're in a startup, they're not really sure where their business is going to go. They're trying to do their financial projections. So how do you plan your finances when you don't really know how your business is going to progress? You know what you'd like it to do, but you don't really know what the reality is going to be. How would you suggest people approach that?
I'll tell you so, Annika.
Yeah, I can jump in. So initially it's kind of looking at where you are here and now. So, starting with protection, making sure that, if you've got children or dependents or anything like that, your lifestyle is protected. And then starting to kind of have those bigger conversations about what are your key aims, what are your key objectives, and trying to kind of then build around that. In terms of kind of, I guess, cash flow forecasting and planning, you could start bringing in things like Voyant to kind of go, well, what happens if I was able to kind of have this much profit for the year or this much, and start kind of building a plan based off that. But it is kind of there's always going to be a lot of unknowns, but it's just trying to kind of formulate a plan, and that's always going to kind of start moving around. It's definitely not set in stone, and it's got to be able to kind of move with you.
Yeah.
If you've got things to add, Mad.
Yeah, I was going to say, just make sure you're not overstretching yourself, and keep a cash reserve back, because quite often we'll speak to people, Annika and I, and they'll say, I'll need access to it within sort of 2 or 3 years, and we will sort of, well, don't invest it, because if you invest it, the market goes down, you need it, you could well be in trouble. So but Annika and I are both very open about that, and we would tell someone if it's not in their best interest to not invest it, we certainly wouldn't recommend they do that.
And I guess that's where those regular reviews come in that you mentioned, Annika, like getting to know someone and reviewing things. So as your life changes and your goals change and you have an understanding of where your business is maybe going to go once you get a bit more established, you can then tweak your financial planning to make sure it matches your situations, I suppose.
Yeah, definitely. And those life events are often the reasons why we suddenly kind of get a phone call or an email to say, oh, I'm having a baby, suddenly protection is suddenly important, or I'm getting married, or sadly somebody has died and there's an inheritance. So there's often life event triggers that will cause conversations, but if you can kind of step back and already have a grasp of your financial plan, sometimes those things, they're not quite so much of a panic time or something to worry about.
Yeah.
But if I can add in here as well, I think it's important when you're running a business just to budget in. It's surprising what you can afford when you budget. If you build you decide to build into your budget some pension contributions, you start off quite small. I'm sure Annika and Matt can start to agree with that. And then slowly build. But if you don't budget for it, you're not going to do it. So there's a time when you've got to budget for it, and it's worth building in right at the very beginning a budget plan to do that. So I'll just add that in.
Yeah. Yeah. No, really good. And John, do you recommend any software that people can use to help them with budgeting?
I would say that nowadays most of us got to use digital software anyway, so you can budget through that. I have to say very few people I know who do it, but you can. But I personally don't know Matt or Annika any software, because it's such a diverse subject. It's best left to talking to experts first, really.
I think there's some great, banks and things that now are, with the apps on your phone, you can really categorize where you're spending to review it and keep a capture on that as well. So those can help with some kind of local phone apps.
Yeah, that's a really good point, actually, Annika. I think my kids are with Monzo, and you can like ring fence different pots of money for certain things, so you know if you're overspending your budget. So I'm not recommending Monzo, but I've never used them myself. But it's things like that. It's thinking, well, what have I got to spend on this month, and maybe saving the stuff quickly before you have a chance to spend it. That's what I've always been thinking.
Well, as I'm sure as John will say as well, having putting money aside to pay your tax bill at the end of the year when you're self-employed, that's you can have a space that you're putting some aside each month. Is a really good idea.
No, definitely. Well, thank you for that. Sorry, John.
I think it's important to plan in advance. We haven't mentioned really the very high rate taxpayers, £100,000 plus earners, but if you plan ahead, you can actually mitigate what happens if you go above £100,000 earnings. You lose all your personal allowance. And the way to do it is to actually bring yourself back into you get your personal is to actually put money into pension funds. So pre-planning is so important. There's no good trying to do this in arrears. You've got to do it in advance.
I think that's a great way to finish this session. Thank you, John. We've got a couple of minutes left, so I'd just like to use that time to thank Annika and Matt, and also John, for initiating this session, for giving us a presentation today, but also the benefit of your advice. We've had loads of questions, so it shows how pertinent this topic is to everybody, and how easy it is not to think about it. And hopefully, if nothing else, everybody listening in today, we've made you maybe just pause and think about where you are. And if you could just do one thing as a result of the session to improve your financial planning, then I think that would be a great start to your financial journey. I just want to say that just a reminder again that we put the link to the on-demand website in the chat. So please do make a note of that. If you want to listen back to this session, you'll be able to see all the slides, you'll be able to see Annika and Matt's contact details. I noticed that John put his details in the chat, so you might want to download that. Marie says she's gone away trembling. Please don't tremble. Talk to your accountant. Drop Matt or Annika an email. Get talking to people and just get some advice and have a plan. And I think once you've got a plan, you know the way forward. So if you found the event useful today, if you've enjoyed it, please do leave us a Trustpilot review at FSB. For FSB, where people do judge us. We talked about how do you find a good accountant or a good financial planner. Well, we're judged by a Trustpilot review, so we'd be very grateful if you put something on about this session today. Just to say goodbye and thank you so much, everybody, for your time.
Okay, can we say you can save the chat if you click on the dot on the right hand side? You can save the chat, because once you come out of the session, you won't be able to see these chats anymore. So you can save it. Sorry,
no, that's fine. That's very true. There hasn't been an awful lot in the chat, but I think John's right. Yeah, it's a very good idea to do it, and then at least you'll have his contact details. And I see that Matt has put his in as well. So. Please do remember to do that before you leave, because you won't be able to come back and do it afterwards. But thank you very much. And we're exactly 1 o'clock, so going to leave it there. Take care, everybody, and have a good rest of the week.
Thank you.
Thank you. Bye-bye.